Hey, good morning, guys. So today I wanted to talk about how to use supply and demand along with the moving average to make money from the market. All right, so I'm going to cover a couple of things. Firstly, I want to say, as far as supply and demand, how do you know what is supply and demand? Hold on one second. One second, guys. Okay, so first, how do you determine supply and demand? There's a couple definitions. All right, supply makes way for demand. High supply pushes price down. So supply is seen by price going down. Demand makes way for supply. High demand pushes prices up. All right. Supply is the amount of an asset available. Demand is the quantity of an asset that people are willing to buy. All right. So we can keep it simple. Supply is when prices are going down. Demand when prices are going up. All right. Here are some more points that will help you to understand how to see this on the chart. All right. When supply begins to range, demand takes over. When demand ranges, supply takes over. Supply and demand, they play tennis or basketball or football. When you score, um, when you score in basketball, for example, you go on defense. When you score in football, you go on defense. Okay, they can't play offense at the same time. All right. Um, Remember, they take turns. After offense, there's always defense. If previous levels of supply have not been broken, supply is still on offense. The previous levels of demand have not been broken, demand is still on offense. Do not buy at supply, do not sell at demand. All right, so let's look at this. All right, so let's just go back to here, okay? We had some demand here. And when I say previous levels of demand, the levels are where price actually, you see a slight move down and price pushes up, right? If these levels have not been broken, you can basically, especially when it comes above the moving average, demand is still on offense, right? So even with this, right, you have small supply within the bigger demand move always, all right? So you have this supply, you have these smaller levels of supply, right? And then it continues to push down, right? Now, it comes into the demand situation because it's under the moving average. All right, so you have to be patient with this because it can come down further. But once you see a demand, which means price pushes up, even if it's just a little bit higher, may not be higher than this high initially, but it's higher than what's been happening. It's higher than here, right? So you mark this as a demand zone, and you look at the previous demand zone and the previous demand zone, at least two previous demand zones, where price made a drastic move that's visible. Maybe one big candle or a few candles that you can see in the last red candle, it pushes up, right? So you can see that if demand, like I said before, if previous levels of demand have not been broken, demand is still on offense, which means you should still be looking for buys. So you got here, it comes up, comes back down, all right? You enter here, you can put your stop loss here, or you can put your stop loss here, right? Now, obviously, there's no guarantee with this. There's always things that we can't control. But for the sake of the system that you want to create to get money out of the market, you have to you have to apply these principles and these rules to give you what to do and what not to do, regardless of what's happening on the market maker side. So if you get in here and you put your stop loss here, and you get that's good. That's a good trade, right? And then going into the next day, you have more demand. You have this high, price pushes up higher, it comes down, right? These lows, it gives you a lower low here, and then a little bit a lower low here, but this low is not nowhere near the previous levels of demand that was created. So you could have bought there, right? 90 pips, right? Then you get out of that trade, and you see what happens. As you can see, the moving average begins to kind of level out. Price breaks these levels of demand, which some may call support. All right, demand and support. Demand is where the movement happens. Support is where demand rests before it moves up. Right. So demand is a move. Support is a location. Right. It's like a platform. All right. So you can look at demand. Support and resistance as platforms for supply and demand. Okay. When it comes to demand, you have support platforms. When it comes to supply, you have resistance platforms, which you can be looked at ceilings. Okay, a floor is support for demand. Ceilings is the roof for supply to go down. All right. So you got your trades in. It's where the patience have to come in, because you know that it's a high. You have a higher high, right? So you patient. You don't just trade because you see another level of it comes to retest the zone. You don't just trade for the sake of getting pips. You want to make sure that you can flow with your rules. All right. So price breaks all these levels of demand. It crushes through them and pulls back. Right now it's under the moving average, and you have these ceilings that the moving average you can see is a visible ceiling because price is under it. Right. And it begins to go down. So now you can tell that you're in a supply situation. You have lower prices pushing down, right? So demand, the moving average is always pointing down, which means even with these pushes above it, you know that you're still looking for sales, okay? So you have a supply here, and a small supply there, right? So even with all these pushes to the upside, it comes here. You got one here, and the ultimate supply was here where it started off. If price is not pushing up and breaking these highs, then you should be selling, right? So you could sell when it comes here and put your stop loss either here or here, and you were good to go. So you got in here, right? Because this is where the initial move happened to create this move down, right? You can get in here and put your stop loss either here or put it here. Either way you go, you smooth selling, all right? And that will be the case as you continue with the moving average being your guide. As far as still going down, you got lower lows and lower highs, right? So you have supply here, supply there, right? Price comes up, it's above this supply, but not above this supply. And as I said before, previous levels of supply have not been broken. Supply is still on offense, which means you should still be looking to sell. All right. So you have this level, right? It went through that level, but it didn't come near this. So you still should be looking for sales, right? So whether you took this one, or this one for the sale, you can have this be your stop loss, or the previous level of supply that created this gap down here. That can be your stop loss. Whatever the case may be, you're still good. I wouldn't take the one that's closest to it. I know people like to have tight stops, but it's just good to have a cushion. So you're looking at, if you took this trade, probably 50 to 70 pip stop loss area, right? And you're good to go. Now, when it begins to shift, the price will shift before the moving average shifts, right? Because the moving average is a calculation of these price points. So how do you know when you should be looking for to go long or to buy? Well, first thing you'll see. Hold on, girls, I'm recording. I told you that. I told you I'm recording. Stop talking, Bree. So you look for higher highs. You look for a break of these small structure points, right? Of these small supplies. So you got this break. It breaks here first and gives you a high. Then it gives you a higher, another level of a small demand, right? And then it comes down. But remember what I said? If previous levels of demand have not been broken, demand is still on offense. Okay, so if you want to get in earlier before the move, so you look for these levels that are minor supplies within the bigger supply move to be broken. All right, so technically, this was a higher high than this one. Then you have these micro highs, very small, very subtle moves that give people the assumption that price will continue down, right? So you got higher higher high, higher low, higher high, higher low, higher high, higher low, higher high. It's a higher low, but it's in the range of it's higher than this low, right? I was watching a video that says that the first the closest zone that closest demand zone, or for this, yeah, the closest demand zone, look for them to break that first one when they're retracing. So this was the last demand zone. You don't expect price to just come here and stop. You want them to at least come to the second one, right? They broke the second one, so but it's still higher than the previous levels of demand, right? So with that, you could have got in, even if you got in here and put your stop loss at this level, you're still good. You may be calling it close, right? But you're still good. So that one or this one, either one, you're in demand. And so as you can see, you get in here, price still goes up. You got demand here, you got a demand here, you got a demand here, right? Now price always comes back because demand and supply takes off, it takes turns. So you got to expect for at some point the supply to take its turn on offense and bring the price down. But if these lows don't come lower than these lows, like for example, it came low, it broke this level of demand, this level was broken, it crushed through all of these, but it didn't come through here. So this is where the patience comes in. You got to be patient. All right, so it comes and gives you this one. So let's say, for instance, you saw that it pushed down lower, and you got in here. You got in at this spot, and put your stop loss at the previous level of demand. Right? It's okay. It's not about how much it is. It's about applying the principles. All right. 90 and it goes up. You got all demand. Nothing about this is saying that supply is about to go on offense, right? Everything is higher highs and higher lows, right? Then it pushes up overnight. It pushes up overnight. You got to expect for supply to go on offense. Even in the uptrend, supply has moments of offense, right? What makes a uptrend and a downtrend is that overall. Okay. Let's make it about sports again, because we have to connect with what we understand already to get a better view of what's really happening. Okay, an uptrend overall is when the Bulls score more points than the Bears, when demand has more points than supply. A downtrend overall is when the Bears score more points than the Bulls, when supply has more points than demand, but both teams are scoring. Okay, when you have an uptrend, you have supply and demand, right? But both teams are scoring. All right, right. Then when you have a downtrend, you have supply and demand, and both teams are scoring, but supply is scoring more points. What do I mean when I say supply is scoring more points? Okay, for example, uptrend, you get more push to the upside. So basically trading against the trend is when you can expect for a counter trend trade within the full motion of a trend to give you the same amount of pips that trading with the trend can give you. That's why it's advised not to counter trend, because you put yourself in the place of losing, because the trend you're taking is the loser of the two trends, right? It may be 49-51. It may be a 70-30 split when it comes to win to lose ratio. With that 30%, if you're trying to find and get pips out of that 30%, you're setting yourself up to lose, because 30% is not more than 70%. So you should be taking advantage of the 70% of the move, because that's the bigger the higher probability of you being right. All right. So let's say, for instance, right, we got this high, we got this high, right? It's a double top technically, right? And you have some pushes down, you have some supply in here, but you can't expect to get the same amount of movement in this counter trend trade when the overall trend is up. So at tops, if you got in this trade, you would have got 38, 40, or 50. Okay, let's say 45 pips tops. But if you was to hold it overnight and wake up the next morning, you would have been in a loss because this is the lower of the percentages, right? So the uptrend, like I said, it could be a 70-30 split, 70% bulls, 30% bears, right? So you can expect to get much going against the trend. When the bulls are winning, the bulls are winning. When the bears are winning, the bears are winning, right? So, all right, so let's continue with what's next. So you got in here and you see that, right? So honestly, you can get out of the trade. That's a nice amount of pips to get out and regroup, because there are opportunities to regroup. All right, you got to be patient though. You can't fall for this. Look how far this is from the moving average. It's super far. All right, so you got this demand, and then you got this demand. This is the one of the first demands that can be attached. Right, price comes down, plays around it, then it pushes way beneath it. Right, but it doesn't come to here nowhere in this first situation. All right, so this is the low. This is the one of the demand that made this big move. Right, price came down beneath the moving average. Moving average still pointing up. It gives you this small demand, and then it kind of plays on here before it pushes up. So even if you got in here, put your stop loss here for this initial move, which is 1 15-minute candle, you risk 50 pips to make about a little bit over 3 times that, right? But you still got to understand that they take offense. It take turns, right? One of the ways that you can see that you can kind of tell when you kind of can have an idea as to when they're going to switch turns is by looking at the previous highs and previous lows, right? So in this case, this was the previous high that was created. Price blew past that. So you got to understand that supply has an opportunity to take over after this price point, right? And then demand has an opportunity to take over after supply then came to this place, right? Look at the previous levels of supply and demand and say, well, price took over here. So if the supply comes down to this point, then we have to be able to understand, especially when it comes to trading with the trend, that demand has an opportunity to take back over, which are demand is for the buyers, supply is for the sellers. So the buyers have an opportunity to take back over after here, especially within this range, even if it comes down to here, right? Which it did. It went through the whole demand initially of the day, but it didn't go through the foundation of the previous day, right? So it came back to this point, which is here, the last supply push of the previous day, right? Still, right? This is where the patience comes in, because you can say, okay, it came here, it went through it, but I still have an opportunity to buy if price comes here, right? Or if you want to just be full out, all in, trusting in your strategy, you could have got in here, right? Or you could have got in here and say, I'm gonna just use the previous day's level of demand, which is support, as a stop, right? So if you got in here and your stop loss was here, you got in here, stop loss here, it may seem like a lot, right? But you made that plus some. Or if you were patient, waited for price to come back to this, then you would have had a small amount of drawdown, which would have been here. So instead of you having 100 pip open for a potential grab, you'd only had about 45 to 50 pip grab, but you still were correct in your analysis. The price continued to push up, right? Price continued to push up. Moving average is still saying I'm going up, right? Now we get to this high. We have some supply, right? Didn't push too far to give you any reason to consider that demand was over. So, as I said before, the previous levels of demand have not been broken. Demand is still on offense, right? So, it pushed down here. If you wanted to buy, you could have bought again. The moving average is still pointing up, but you got a lower high supply here. It pushed up, right? Now it didn't break this high, right? And now you got lower lows and lower highs. Nothing is saying you're not. Obviously, you're not sure. You got lower highs though, which is saying this supply could be setting you up for a change of trend. Then you have this major move, right? You can't ignore. You had this supply, then you had this supply, right? You can't ignore that, right? You got when supply is, don't talk, go out. When supply is showing you, hey, we're taking over. Don't just say, well, I'm just still gonna buy because I still believe it didn't go beneath this low. It didn't go beneath. Yeah, I get that, but the takeover is not always obvious. It's not always obvious, all right? So let me see what we got. All right, so it comes up. Now price is under the moving average, right? It's pointing down. It's saying, hey, the takeover is here, right? So you had this level of supply. It broke up through that, but it didn't come back to here. So especially with it being under the moving average, right? You get in here, and you can use either this spot or you can use this spot as a stop loss for your trade. And then supply shows up. It shows up slow. It gives a false, especially with the moving average, it's telling you the supply is here. It's already giving an umbrella for price, right? But then on price action, depending on how convinced you are that it's still an uptrend, after you just seen 1, 2, 3, 4 lower lows, if you're buying here, it's false hope, right? You should be selling. You never should be buying, and do not buy a supply and do not sell a demand, right? So if you're in this trade, nothing is saying get out as far as you're wrong. Everything is saying you got lower highs and lower lows. So you here, right? That's a 400 and at least, what was that? For what? So here is 450, here is 470. So like between 450 and 470 pips, right? And then what do you have? Remember, on a supply, there's still a moment for demand to have its offense because they make waves for each other, right? So you got a little demand move going on. You don't take that to heart because the moving average is still showing you that supply is still on offense. All right, it goes up. It's above the moving averages. All right, you got a high here, but these highs are nowhere near this previous level of supply. So what can you do? You can sell. You sell that all day. You got this one and this one. So if you got in, let's say for instance, you got in the one that confirms what you already know, the one that the lower high, right? Let's say for instance, you got in. Let me click on this. Why it's not showing? You got in right here, right? So 154 pips of stop loss to make about 300. So that's like a 1 to 2, which is still great, right? It's still great. Now, like I said before, every time price breaks a level where there was a demand move, you got to expect demand to have its opportunity to be on offense, right? And every time demand breaks an area where supply was on offense, you got to expect supply to have its turn on offense, right? Supply had its turn on offense here, right? Demand breaks this space. You got to expect for supply to have its turn on offense. It's like playing basketball, y'all. But you gotta, and this is why you gotta keep looking at the charts. So watch this one. This low, right? And the more you look at this stuff, the more you see the game. It's a game, offense and defense, right? So you had this low was right here. Is where demand was on offense. Supply breaks this spot. You got to expect for demand to have its turn on offense. From here on up is demand. It takes its turn, right? You have to have, right? For example, pushing up, then you had supply on offense. So you got to expect that anything under this point is a supply on offense, right? Demand had to turn on offense. You got to expect that everything from this point will be demand on offense. It's not hard. It's not hard. It may be short-lived, but you gotta know that these areas where supply took over and where demand take over, it's like back and forth, right? So let's just give you an example here. Let's stretch this out to just show you some stuff. These points, supply took over here, demand took over here, right? So if you trade from supply to demand, right, you would have got at least these two trades, right? Supply took over, demand took over. You sold that and you bought that. Just those two trades alone would have been consistent, right? Just going back to where it showed you, right? And so let's just keep going. So you have supply here. Let's see. You got a supply here, and here's the thing: these places that you see supply and demand, they don't just stretch over the day. It stretches over many days, especially with a bigger picture, right? So you got supply here down, and then you have demand here. So you played this game. So we had this, we went down, and then from here it went up. So anything under this point would have been a sell. Anything here would have been a buy. So if you played this 150 pips, and then you took the same trade back up to that same spot, 160. It happens every day, right? Here's another one. This is another situation of being able to see, right? So you got demand here, and you have supply here. So anything above this point is demand. Anything beneath this point is supply. So you wait, right? If price can't go up, you wait for it to close under. So from here down to this is 170, and then from here back up to here, which it happened the next day, is another 170, right? Same thing. You got demand, you got supply here, right? And then you have demand here. Same thing. Now, like I said before, you're not going to always get an equal amount of movement on both sides, depending on who's running the show at the time, right? So if supply is giving you the 160 or the 150 or whatever, and demand, you were able to make the 60 or the 50 to the 70, it's still a good day, right? 210 pips. If you was trading at $1 a pip, that's $200 a day. Most people make that type of money, they're going to be supervisors or managers, right? And so you see that, right? And so, like I said, the bigger picture is this. You got supply here, come all the way across. You got demand here, come all the way across. So if you play this, you see how, like I said before, if previous levels of demand have not been broken, demand is still on offense. They have not been broken, right? This was the lowest spot. What you see, you got a wick here, pushes up, wick here, pushes up, right? It pushes up all the way up to here, which is the previous level of supply. If you took this trade for 250 and then took the sell, right, for 220, and you still see previous levels of demand that have not been broken, that's a 470 pip day, ultimately setting you up for even a greater opportunity because demand is getting ready to take over, right? So you got this previous level of demand. Remember that first level of demand can be swept, liquidity grab, right? Second leg is always the most volatile. But if it's a legit uptrend, it won't break every previous level of where demand was there. And so you see that, right? So you got in here, price goes up, you're in an uptrend, right? You're gonna have some slight grab in the movement, right? You got demand here and demand here. So even with this, it's more it's more for you than against you if you're trading demand, right? So any one of these points, especially if you trade after this push, because this push is showing you that all these small all these small supply moves didn't matter, because this one move took out all the movement that was given in the London session. Then it comes back down and gives you a higher low. So if you got in here with your stop loss probably here, 60 pips or 70 pip window for ultimate 500 pip move, because you understand the game. You got to understand the game, right? It's a game. That's all it is. Even with these big crazy moves, right? You had supply here, and then you had this supply here, which was greater than this supply. So you mark that. You don't overlook that. That's a opportunity where I can see something, right? So that's supply. So it comes down. It gives you a low. It gives you you can see the obvious W. We understand that, right? So when it comes back up, if it comes under and closes, that's a supply entry, right? And you see that one trade, you made 500 pips here, this trade, and you got lower. Now I think it's telling you, and if you want to be careful, I can understand it, just to put your stop loss above here and go to sleep. Leave it alone. Do not overtrade. I want to say something about overtrading. You don't buy every single little move in a. You don't buy and sell. You don't sell, buy, sell, because you end up getting lost in the maze of the back and forth. Let the move take its course. Whatever you don't have as far as capital size, once the move is complete, you will have another opportunity to trade, right? So if you made 500 here and you see this demand, it come back down, you could have got in here and made another 250, 220, right? So you done got about 700 pips already. It don't matter what you had. You got enough to take a better trade, right? And then you have supply. It may be giving you higher highs, but the higher highs temporarily, right? But then it breaks. It doesn't come. These supply zones are not pushed higher than these previous levels of supply, so you don't fall for these moves, right? You have no reason to get out of this trade. It goes down. Boom. Now, like I said before, you got to expect for demand to take over. You got to look. You have to believe that it's supply and demand. They take turns on offense, right? So even with this move, once price breaks this, you got to be on the lookout for demand, because they about to go back on offense. Even if it's temporary, they're going back on offense, right? And then once you see, because this was a previous level of demand, once you see that, you don't say, well, it's going to continue to go down. You just let it play its course. And then once you get higher highs and the moving average confirming that its demand is on offense, you trade the demand. That's all you do. That's all you got to do. So I don't know how long I've been going on in this video, but please watch this video over and over again and realize, I'm going to break it one more time. When supply begins to range, demand takes over. When demand ranges, supply takes over. All right? Right? So you got to, but it's not going to just happen. You got to see it. It's going to show you that it's happening, right? Supply and demand play sports. They take turns. After offense, there's always defense, right? Everybody gets a chance to score, right? If previous levels of supply have not been broken, supply is still on offense. If previous levels of demand have not been broken, demand is still on offense. Do not buy at supply. Do not sell at demand. Okay? It's real easy, guys. Take your turn, watch the videos, and just continue to watch it and remember everything that I said about offense and defense. All right? I'm gonna just do this one more thing to show you what I'm talking about. Let me get rid of these objects. There's a lot of them on here. All right, so the bigger picture. When it's a downtrend, the supply is on offense. You'll have small demands in here, yes, but you'll get most of your pips to the downside. When demand is on off, and it even happens on the bigger time frames, guys. Like, look at this. You got to expect for previous levels of demand to have opportunity to go on offense. All right. Now, as you can see with gold been on offense for a long time. And even in this, like, for example, demand. This one move was an entry that like no other. This was the last time that gold was under the 50 moving average in the last 2 years. This one entry would have made you six figures. If you took $100 a pip from here, 1820. Let me just do the numbers. I like to see the numbers. All right, so let's just see. Let's say, for instance, you had 10,000. I'll say 20,000 because we want to be legit, be kind of realistic. $20,000, and you took $100. Let's say you took $30 a pip with $20,000, right? So right now it's at 45.31 minus 18.21, right? That would have been about 27. Is that 27,000? About 27,000 pips. Something crazy like that. 27,000 pips, because I know every tick is 10 pips. So it'd have been about 2,700 ticks. So 27,000 pips, right? So that 27,000 times 30 would have been 810,000. So within 2 years, from that 20 grand, you would have made 810,000 off one trade. Now, obviously, it wouldn't have been a whole 810 because you got swap fees, all them other stuff. But my point is that understanding the game puts you in a better position. Whether you want to swing trade or day trade, you understand the game, right? You got higher highs and higher lows. You got to know that for the last since October of 2023, really right here. But I'm just saying because it's above the moving averages with the pullback. Since the beginning, since January of 23, gold has been on offense, right? That's how you know gold has been on offense with supply. Demand has been on offense. Forgive me. Demand has been on offense with gold, and therefore you know how to look for it. But as you can see, even with supply, you got supply here, supply there, supply here. These just knowing how to understand the game puts you in a better place to not be afraid, to not have FOMO, just to be in a better mental space to trade. So I hope this helps you guys out, and I can say definitely with me making these videos, it's definitely helping me with clarity, and I just want us to be able to win in 2026 without having any hindrances, and being able to have the proper understanding and to cut our losses, be able to know when to cut our losses short, and know what we should be trading based on knowledge and not just how we feel. So with that, I pray you guys have a happy new year. You gotta be safe out there. Once I upload this to my YouTube channel, I'm going to upload it to my Facebook page. And then if you have any questions, I'm pretty sure if you watch this video, a few times, as many times as need be, your questions will probably be answered. So have a good day.